Welcome back to the Digital Asset Report. Bitcoin is trading around $71,000 today, with Ethereum near 2,080 after a broadly positive green day on Wednesday, reaching new monthly highs. The market is still taking cues from geopolitics and rate expectations, but the bigger signal this week is in the rails that major crypto institutions are plugging into. Kraken Financial, the Wyoming chartered bank inside the Kraken ecosystem, has been granted a limited purpose master account at the Federal Reserve, approved by the Kansas City Fed for an initial one-year term. Kraken is the first crypto institution to secure a Fed master account. That means direct connectivity to core US payments infrastructure, including FedWire. That's the same backbone banks use to move trillions on the daily. Instead of routing dollars through partner banks and correspondent networks, Kraken can move fiat directly on the Fed's pipes, starting with the institutional flows first. Even in limited purpose form, it's a blueprint other regulated digital asset banks have been chasing for years. It also puts the banking sector in the spotlight because direct access is the line between crypto being a customer of banks and crypto being a bank.
This is going to be a huge asset, and today's announcement by Kraken that they now have access to a Skinny Master account is going to add another opportunity for the new integration of the fiat dollar with digital assets. So this is a huge step forward. Very happy to see the Fed finally realize that we can integrate these financial products in a way that benefits Americans.
Senator, explain the news with Kraken, because I'm not sure I understand it. I've read it, but I don't entirely understand it. The news that the Federal Reserve is now going to be accepting this first digital asset company to earn a master account. What does that mean?
Kraken used a Wyoming law that was very foresightful, called a Special Purpose Depository Institution, to form. Wyoming has a very comprehensive, clear examination for safety and soundness of these companies, and yet under the Biden administration, the Fed would not approve digital asset companies that formed similarly to access the Fed's payment window. So there wasn't a way to integrate digital assets with the US fiat currency. Kraken has now become the very first digital asset company to gain access to the Fed window. The Fed finally recognized the importance of this asset embedding in the US and can now use safety and soundness standards, apply them to digital asset financial institutions like Kraken, and have partial access to the Fed, which allows them to begin integrating the US dollar with digital assets. It really is going to be the future. In the future, you're going to see banks buying digital asset companies buying banks. So if you go into a bank, they can serve you both in fiat currencies like the US dollar and digital assets like Bitcoin. It's going to create the 21st century financial services industry.
Also this week, SoFi and MasterCard announced an expanded partnership to enable SoFi USD as a settlement option across MasterCard's global payments network. SoFi also selected BitGo Bank and Trust to provide the stablecoin infrastructure behind SoFi USD and to support distribution by working with payments providers, market participants, and exchanges to broaden institutional access. BitGo's doing that through its stablecoin as a service platform, providing the technology and operational plumbing that supports issuance on a public, permissionless blockchain. In other news, Northern Trust Asset Management launched a tokenized share class for its NIF Treasury instruments portfolio, essentially a blockchain record of an institutional money market fund share class. The initial distribution runs through BNY's Liquidity Direct platform and Goldman Sachs digital asset infrastructure. This is a pattern to watch: large managers bringing Treasury collateral on-chain without changing the underlying investment mandate. The aim is faster settlement and cleaner operational tracking. Meanwhile, Standard Chartered was appointed digital asset custodian and settlement agent for TP ICAP's Fusion Digital Assets platform, adding a regulated custody and settlement layer to support institutional spot crypto trading at scale. That means client assets can be held in institutional-grade custody with clearer segregation, controls, and reporting, while trades on Fusion can settle through an integrated post-trade workflow. The combination is designed to reduce counterparty and settlement risk for users. And crypto derivatives are also being rebuilt built for a multi-asset world, SIBO published a proposed rule change that would make it easier to list options on commodity-based trusts that hold multiple crypto assets, rather than forcing a bespoke approval cycle each time a new basket product hits the market. This is another step for the same toolkit institutions already use in ETFs and commodities, now applied to diversified crypto exposure with compliance and liquidity criteria baked in. And the last thing we'll leave you with, Chainalysis published new data showing illicit on-chain activity was driven in 2025 by a surge in sanctions evasion and state-linked flows. As crypto connects more directly to the traditional payment system, the premium on surveillance controls and clean counterparties goes up. Institutions want the upside of 24/7 settlement, and they will only scale it if the risk stack is compliant. Kraken's getting into the Fed's pipes, MasterCard experimenting with stablecoin settlements, and legacy asset managers tokenizing Treasury exposure. This is what mass adoption looks like. That's all for this week. If you enjoyed this episode, be sure to give us a like and follow along for more.